Welcome to this webcast about risk mitigation intention. This is webcast 4 out of 8. This webcast is separate to the general overview webcast and focuses on the definition and the determination of the risk mitigation intention and the construction of the benchmark derivatives. The risk mitigation intention is a new DRM element introduced in order to incorporate the concept of risk limits, that is, a range of acceptable outcomes. While acknowledging that an entity's risk management strategy specifies risk limits rather than a single targeted outcome, in our view, measuring the DRM performance against a range poses significant challenges and would likely not result in useful information to the users of the financial statements. The risk mitigation intention fulfills a similar role in the DRM model as the risk management objective in the general hedge accounting model of IFRS 9. The risk mitigation intention can therefore be described as the extent to which an entity intends to mitigate the current net open risk position through the use of derivatives, as illustrated in the chart on the left-hand side.
There are a couple of unique features about the risk mitigation intention that are worth highlighting as shown on the right-hand side of the slide. Firstly, the risk mitigation intention is a risk exposure within a particular time bucket and could be expressed in an entity's preferred risk metric, for example PV01 or nominal terms. Although it is a portion of the entity's current net open risk position that the entity intends to mitigate, it does not specify which underlying items give rise to such risk exposure. As such, under the DRM model, all underlying positions are managed equally and holistically. The risk mitigation intention specifies only the extent of risk an entity intends to mitigate rather than the extent of the underlying position an entity intends to mitigate. For example, when an entity decides to mitigate 60 in PV1 terms out of a total current net open risk positions of 100 PV1, it does not need to specify whether that 60 PV01 is made up of 60% of all underlying positions or a particular subset of underlying positions that have a total PV1 of 60. Secondly, the extent of risk to be mitigated shall be evidenced by real actions taken in the market, such as the actual derivatives traded. This is because the actual externalization of the risk is an objective indicator of the extent of risk an entity wants to mitigate. This provides robustness to the determination of the risk mitigation intention and prevents entities from setting the risk mitigation intention artificially to achieve a particular accounting outcome. For example, when an entity has a current net open risk position with a PV01 of 100, but chooses to mitigate only part of this risk exposure by entering into a pay fixed derivative with a PV01 of 80, the risk mitigation intention cannot be artificially set as a PV01 of 100. In other words, under the DRM model, an entity would not benefit from deliberately underhedging its net risk exposures in order to minimize the misalignment P&L. Thirdly, despite the requirement of evidencing the risk mitigation intention with the designated derivatives, the risk mitigation intention shall still represent the extent of risk that exists within the current net open risk position, and shall not simply impute all the terms of the designated derivatives, as explained later in this webcast.
Last but not least, although risk managers are free to decide its risk mitigation actions in the market, the risk mitigation intention will be determined by accountants as a separate process. To ensure the robustness of the DRM model and to maintain the discipline in accounting, the risk mitigation intention needs to satisfy the prospective assessments, which means, firstly, at the time of designation, that is the start of the assessment period, the risk mitigation intention cannot create new risks in addition to the current net open risk position. In other words, the cumulative amount of risk to be mitigated through derivatives must reduce the interest rate risk of the current net open risk position by time buckets, and cannot exceed the total amount of risk by time buckets. In other words, an entity cannot overhedge its current net open risk position in any time bucket. For example, if an entity has a current net open risk position of PV01 of 100 in a particular time bucket, the risk mitigation intention cannot be set at 120 to create a new received fixed exposure of -20. which is also known as overhedging. Similarly, it cannot be set as -10, as that would increase the total risk from 100 to 110. In case the risk manager decided to take these risk management actions regardless, the accountant will have to limit the risk mitigation intention to the maximum level allowed, that is 100 in the first case or 0 in the second case. Secondly, the risk mitigation intention has to transform the current net open risk position to a residual risk position that is within the target profile. Since this would only happen when the risk managers failed to meet the agreed risk limits, or the target profile, it will have significant implication to the entity, and as a result, this is not expected to happen often in practice. The risk mitigation intention may be changed prospectively for each DRM assessment period, but once it is determined for that assessment period, it will be documented via the construction of the benchmark derivatives, and the entity will not be able to amend the risk mitigation intention for that period retrospectively. As we explained earlier, the risk mitigation intention is just a risk exposure which cannot be measured directly for financial reporting purposes. As a result, the DR model requires the entity to construct the benchmark derivatives, which will be used as a theoretical single outcome valuation anchor for measurement purposes. Similar to the hypothetical derivatives under the cash flow hedge accounting model, the benchmark derivatives are mathematical expedients to enable the measurement of the risk mitigation intention, and thus they have to fully represent the risk mitigation intention. In other words, the valuation change in the benchmark derivatives need to reflect the valuation impact directly caused by the interest rate risk the entity intends to mitigate, i.e., the risk mitigation intention. As a result, the benchmark derivative cannot impute the terms of the designated derivatives, but instead it shall reflect the features inherent in the risk mitigation intention. One possible example of such benchmark derivative is a vanilla interest rate swap with a maturity date matching the time bucket of the risk it needs to represent, a floating lag reference to the same benchmark interest rate the entity is managing, such as 6 months Euribor, and a fixed lag to ensure the derivative has a zero fair value on the construction date. This means that the benchmark derivative must be determined using the on-market spot rate for the managed risk at the time of designation.
Thank you, Siggy. Could you elaborate further what it means that the risk mitigation intention is evidenced by real actions taken in the market, such as the actual derivatives traded? Would this lead to outcomes whereby benchmark derivatives equal designated derivatives, resulting in perfect alignment?
Well, as we mentioned earlier, the actual market action gives an indication on the amount of risk an entity intends to mitigate, but the actual type of risk is still determined by the extent of risk that exists within the current open risk position. For example, an entity may trade an ESTA versus fixed derivative to mitigate the NII variability caused by a fixed asset and a variable liability linked to a 3-month Euribor. In such cases, the derivatives indicate the amount of the risk mitigated, but the risk mitigation intention has to be based on 3-month Euribor instead of ESTA. A 3-month Euribor represents the managed risk. Accordingly, the benchmark derivative shall be constructed as a 3-month Euribor versus fixed, and the difference between ESTA designated derivative and the 3-month Euribor benchmark derivative is likely to cause misalignment measurement.